There are four key questions that we ask of all our investments. The first, is this a good business? One which has earned high returns on capital. Second, do we understand the nature of its competitive advantage? The competitive advantage that protects those high returns from outside firms from coming in. And third, how confident are we that those high returns are going to be sustained indefinitely? Those three questions deal with what we want to own. The fourth question, valuation, dictates when we own it. There's no point finding great companies. What you need is a portfolio of cheap stocks. And in terms of valuation, our primary measure here is whether the price to free cash flow ratio on the stock is less than that of the overall equity market. Now typically, with this process, we'll end up owning areas such as consumer products, healthcare, software, media, and so on. These are all capital-light industries with less sensitivity to the overall economic cycle. A good example of this is Unilever. It's the largest holding in the fund. Our investment in Unilever brings with it a high natural level of diversification. Unilever sells thousands of products in 200 countries around the world, produced from 100 different factories. It also has a very strong emerging market footprint, and indeed the company has grown its sales on an organic basis for the last 34 years, every year for the last 34. And it's held or maintained its dividend for the last 50. Unilever is a very strong company, and yet it seems overlooked by the market. And in many ways, the only reason we can really come up with for that is, frankly, the boring nature of what the company does. A lot of investors are looking for stocks with a catalyst. They're looking to hit a performance hurdle within the next year or an outperformance target within the next 3. But for us, Unilever doesn't have a catalyst. Size. In many ways, it's just the mathematics of running a concentrated global equity fund. I think that when you get much above $10 billion of assets, it becomes much harder to initiate new positions or sell existing holdings, maybe 3, 4 or 6 months of steady trading without impacting the price. We have 750 million of assets, so there's a fair way to go before we get there. In some ways, no. The nature of the types of companies that we seek to invest in are those whose stock prices tend to lag the very best years of a bull market. Since the fund launched, global equities are up around 20%. It's been a very healthy year for equity returns. And yet, pleasingly, the performance of the fund has actually risen by more than that of the overall equity market, and certainly by a lot more than a simplistic style analysis of the fund would suggest. So what that really tells you is it's all about the stock picking. I think people mistake a lot of what a bond proxy is and what a bond proxy isn't. Take a regulated utility. This is definitely a bond proxy. The cash flows don't vary very much according to the economic cycle, and yet those cash flows are very sensitive to the discount rate, the interest rate that you apply to those cash flows. Interest rate goes up, present value of the equity goes down. A regulated utility is definitely a bond proxy. But I think people are also overlooking bond proxy elements to a lot of other stocks out there in the market, particularly tech shares, and even more so those tech companies that promise shareholders a great pile of profits someday off into the future. If you think about a large pot of profits on the other side of a rainbow, the duration, the valuation, the sensitivity of that stock's valuation to interest rates is actually very high. So companies like Amazon, companies like Netflix, in our view, have more elements of a bond proxy to them than others appreciate. Yes, the fund registered a small decline in the third quarter, a shade less than 1%. This was in the context of global equity markets that were up about 4% in the third quarter. Now, the fund isn't managed on a quarter-to-quarter basis, and instead we have a 5 to 10 year investment horizon, and since inception, the performance of the fund has been very pleasing. But yes, the third quarter was a little disappointing for us. The first reason for that is again back to the nature of the businesses in which we seek to invest, the stock prices of which will just tend to lag the very best years and the very best months of a bull market. The other reason was our investment in Equifax, which cost the fund about 1.5% in the quarter.